Um, but I'm curious, just generally speaking, I know that every endowment is going to be a little bit unique, but I think there are some sort of broad principles that likely apply just about anywhere. In a typical situation with an endowment, um, the investment side, how much discretion does one have with respect to where the funds are invested, and how much is that sort of directed from sort of some overarching policies that have been set? Does that make
Yeah.
sense? My question
Yeah,
makes
no, yeah,
sense.
it makes complete sense. And it does vary, by from school to school or endowment to endowment. So you'll have, let's see here, generically speaking, the larger the endowment. So I mentioned Texas at whatever it was, 60 something $billion. They have a gigantic organization called UTIMCO, and you can find a lot of information online. They have a huge team. They have lots of accountants and lots of financial operations people and lots of investment analysts and directors of research. And then you have smaller shops like us, where we're a team of four, and that team of four is two investment people, me, and then another senior investment analyst, and we handle more of the investment research side. And I'll elaborate on that in a bit. And then we also have somebody who's dedicated just to the operations and accounting, kind of in a first and second string role there for him, and then an accountant. And she helps out on the operations side, but predominantly focuses on accounting. So we're at 1.3 billion. You see all four functional areas, not the marketing, right? Like you said, that's really a different area of the university's responsibility, although we're involved in it often when we have to answer questions or produce materials. But the day-to-day mechanics of managing an investment portfolio like this are financial operations, which are very complex and very important, as a lot of money moves around and often in large sizes. The accounting, that is literally a daily process, and then monthly, quarterly, yearly. And then you have the investment research. So in terms of the discretion, what you typically have with endowments and large pools of money, even at, like, let's say, a hospital or any kind of a research foundation like the American Heart Association, if there's money there to support its operations, is a committee that will oversee in some way the overall management and operation of not just the organization, but then the actual investment process and portfolio. You will often have, if you've got a large enough organization, investment staff like us. And to your point, folks who are interested in investments would gravitate in that direction from a career standpoint, or accountants would, as well, if they want to do the accounting side. And then you'll end up a lot of times, and this applies to us, you'll have, depending on the size of the endowment, an external investment consultant. So Texas, for instance, at $70 billion, has enough money to basically do all of its research in-house. They have people who are skilled in risk management. They can invest in expensive systems. They can travel all over the place to find all the investment managers they want. We're not in that position. So we utilize the services of an investment consultant, and there's information out there on our website about it, Cambridge Associates. So we, as the investment staff internally, work with that consultant on all facets of portfolio management, asset class research, investment manager research, subsets of the market that may be presenting an unusual opportunity because of dislocations or structural inefficiencies. And I report internally to the chief financial officer here. And then there's also a periodic meeting with the investment committee comprised of 8 people. And they oversee, when I say all of it, not down to a high level of detail, but there's a lot of reporting that goes on there to say, here's what the portfolio looks like, here's how it's performing. Here's how we're all looking at risk from the standpoint, not so much of we think the market's going to do this or that, because obviously that's beyond the realm of anyone's knowledge, but we're looking more at how we've constructed the portfolio, what risk factors we're taking into consideration. Here's what we believe this portfolio will, how it will behave in terms of volatility or potential drawdowns or decrease in value. And the investment committee looks at all of that, looks at how the team is working, what kind of resources are being brought to bear by the consultant, and may say, hey, we're not comfortable with this, we need more information, or hey, why have you done that, or why is your firm, if it's the investment consultant. China is a good example. Lots and lots of discussion recently in investment committees around the country about China. Should people be investing in China? Is it advisable? If you are investing, how should you do it? Should you do it in illiquid strategies that may be hard to get out? Should you stick to public equities that you theoretically should, can sell? All those kinds of discussions take place internally with the investment consultant, if you have it, and then up to the investment committee that oversees the whole thing. And so that's kind of the broad brushstrokes there.
Well, I want to throw out a couple of buzzwords here, and I want to get your perspective on how each of those enters into the investment process in a typical endowment. So one of these buzzwords is asset allocation, and the other one is security selection. So asset allocation and security selection. So initially, a lot of students will get into finance, and they'll think, okay, I want to figure out which single stock to buy today so that I can retire a gazillionaire. And so that is security selection to the extreme. But
if you have any students that can do that, please let me know.
They're already working for me. So, and one of them's my son. So yeah, my 14-year-old, I mean, he's got his little $100 brokerage account. So he's changing the world. But, so asset allocation and security selection. So how do those enter into this investment process for an endowment?
Well, it's funny. I don't know if this speaks to the positives or negatives of business education, because I went to business school myself. And so when I was thinking about how you and I would chat about this, the two broad areas of investment management that I was going to try to address were asset allocation and security selection. So we're on the same track. Hopefully that's a good thing. I think thinking about it from the standpoint of a student who's in business school or somebody who's just trying to understand an endowment better, those are the two broad areas. And for investment management writ large, you could kind of look at and say most of the investment world can be captured under one or the other. So if you're, maybe I'm dating myself, but if your students were to look at a mutual fund and say, hey, I want to go and be a portfolio manager someday of a mutual fund that invests in stocks around the globe, that person's going to become, or I want to go be an investment analyst at Fidelity on a stock portfolio, whatever. I want to go do equity research. That person is getting into the world of security selection. They are out there looking at individual stocks publicly traded that are available. They're studying the company behind it. They're studying the industry behind the company and so on. And they're picking specific instruments in a capital structure of one company. They'll then take those, either through a research capacity or portfolio management capacity, and assemble it into a portfolio. And the portfolio manager is engaged in the same thing, portfolio construction of individual securities. Asset allocation is a bit of a different beast in the sense that, while some mutual funds, for instance, just to keep it at that level, might encompass and include different assets, like usually stocks and bonds in a balanced portfolio, an endowment a pension, like we have in Nashville managing the pension for the state of Tennessee, or an insurance company, their portfolio, it's going to look at not just individual securities. And more often than not, they won't be picking individual securities. They're looking at assets like public stock, public bonds, private equity, real estate, and they're trying to take all those broad asset classes and assemble a diversified portfolio. And then more often than not, and almost always in endowment land, they will then pick the managers in those various buckets of assets to do the actual security selection. So in our position, working with our consultants, we're not picking stocks and bonds. We're hiring people or investing in a product like an index product that actually goes out and buys the stocks and the bonds or whatever it might be. So we are a manager of managers, and it's the managers who do the security selection. We're trying to compile the portfolio of assets across all different types that then make a whole portfolio. So I don't know whether that.
Yeah, so you're thinking about classes. So again, classes of assets. So corporate bonds would be a class.
Yeah.
U.S. public equities would be a class. Emerging market debt would be a class.
Yeah, exactly. So, and a lot of times the lines between them can blur. If you're looking at emerging market debt, be it sovereign, in other words, a country's debt, or a company's, and then you're looking at high yield debt in the United States or high yield debt around the globe, which would be corporate, you might begin to say, okay, some of the volatility ignoring currency there is going to be the same. Some of the correlations will be the same. So you might lump some of those different subcategories together to be credit, right? It would be the broad term you'd use for all of what you just discussed. And then other times you might say, well, no, emerging markets right now behave very differently than, let's say, US high yield corporate debt markets. They've really traded off because of whatever geopolitical concerns or the dollar impact on, dollar denominated emerging market bonds. So then all of a sudden there's an opportunity or maybe a reason to stay away. One thing that I think people don't realize is we are not following the zigs and the zags of the market on a regular basis and trying to time anything. Rebalancing is one of the best tools that a person in our, people in our position or endowments can engage in to make sure they manage risk properly. And you could argue even take advantage of some of these opportunities. There might be something that pops up, like let's say master limited partnerships in the energy space. They traded off hugely a number of years ago. And so that was a very unique and specific subset of the market that presented an unusual opportunity. So we took a look at some of the strategies that were there because our consultant was watching this as well. But broadly speaking, if we have a long-term rough target, keeping things simple of, let's just say roughly 60-40 stocks and bonds. And that's, from a risk standpoint, that's kind of how we try to construct the portfolio.
And this is top. I mean, this is classic top-down approach, right? You're thinking, you're thinking two broad classes, stocks and bonds, 60-40, and maybe you have some subclasses within those. But again, we're talking about diversification across groups of assets, not across securities.
Right, exactly.
Within each of these buckets, then you're going to drill down.
Exactly. And so, for instance, like we're sitting right now recently around a 47% allocation to public stock, and it's global. We've got some in the US, some emerging, and so on. The markets have generated tremendous returns in different pockets of the equity markets. And so we watch that, and we don't robotically rebalance, but we do systematically rebalance. And, you and I are talking about this all the time in the investment committee that you and I sit on.